Let's answer some questions from the last market outlook. I have not had an opportunity to see, I think, more than half a dozen of these. Haven't taken a single CFA, but bought the applied level, hoping I'm going to be grandfathered in going forward. Yes, you will. Anybody who is a subscriber before July 31st is grandfathered in. That means that any new module that has any recurring fee, you would just simply get for free. Let's see, MicroStrategy. When you say there's no leverage to the upside because the convertible debt would convert on said upside, are you implying that this is due to dilution effect upon conversion? Correct. Existing shareholders would be no better or worse off. Well, they would be no better off, but they would be worse off because let's just do it this way. Let's just say that's the dividing line between conversion and non-conversion, and this is the price of MicroStrategy. If MicroStrategy is above that conversion price, all the shareholders will convert. I mean, all the convertible bondholders will convert, which means the price of Bitcoin must go up for the price of the stock to go up, and it'll be dollar for dollar, $1 for $1. But if it's below the conversion price, then you have to pay back the debt, which means the payoff would then look like this to the downside, which means roughly about for every $1 drop in Bitcoin, you would lose $2 on MicroStrategy because this debt would stay the same. Above this level, you don't have to pay back the debt, but it becomes equity. Below this level, debt stays debt, which means you got to sell more and more and more Bitcoin as the price drops to pay back the same amount of debt, or sell more and more shares to pay back that debt. So it's asymmetric. There is no upside, but there's 2 to 3 times the amount of downside. Understand you do play on Oxy trade, but what is your outlook for energy stocks overall? It doesn't really, you have to separate the price of oil from the price of oil stocks. I think there's going to be consolidation in the industry for quite some time. So that is enough to keep oil stocks, I think, at a higher price than the price of energy or the price of oil would dictate. There's lots of oil right now, and I think that given time, as you get consolidation, larger companies will manage that supply down. So overall, I think it still looks good for energy. Have you ever considered to study more about Argentina? No, you can't know everything. And as you start spreading yourself more and more thin, taking on more and more markets, you will end up knowing a little bit about a lot, but not enough to make any significant trade in any market. So the U.S. market is big with lots of opportunity. I'm good. I'm really good there. So no, I don't really, if you can't find opportunity in the U.S. market, if you have to start hunting around the world for opportunity, I think maybe you might be missing some things. But no, I know nothing about any other market. So rather than me say I know nothing about Argentina and then I know nothing about Japan or I know nothing about China, I can just tell you right now I know nothing about any other market. I barely know much about Canada. Even though that was my home country for the longest time, I couldn't tell you anything about the economy, much more than just a few headlines. The U.S. market is where I've always played. Borg Warner. I started my position about a year ago. 100 shares at 45. Didn't get much action since then except for red everywhere. Yeah. Started selling puts on it again a few months ago. Will happily accept June 21st 37.50 assignment. Sell July or August puts 35 or even 32.50. Mature quality business, good cash flow and debt management, strong product offering, stand to benefit from OEMs keeping ICE longer and transitioning EVs more gradually. What else, if anything, made an attractive stock for you to sell puts on? Valuation, it's come down quite a lot, and they're a significant tier 1 supplier. Related to MSTR's revenue recognition, did you look at critical audit matters on page 70, 71? No, I didn't really do a deep dive. I scanned through it, and usually your first pass on a 10K, you're circling things and you're putting question marks saying, well, I got to know more about this. it wasn't as if I had gone through the whole thing and I said, this is odd. I still don't have an answer here. It hit me as odd because I'd never seen that before. But there are accounting practices that say under certain conditions you can recognize everything as a receivable, even if you haven't billed it yet. So it can be done. It's just I've never seen it done before. And you wonder about the motivation of why you would do it. They've made a choice to do it, and as long as they're consistent in that choice, and you can't fault them for that, I guess. The video about what to know about taxes for retail investor. Well, I can't. What country? What type of income? What tax bracket are you in? So, depending on how much money you make in other sources, depending on what country you're in, and depending on what tax you make and how you make it, it would be an endless video. I'd have to make a whole bunch of assumptions. The way you get treated on taxes would not be the same way that I would get treated. So it would be, whether it makes sense to invest in foreign markets from this tax, what country, right? There's so many things I would need to know first. There is no one answer to that. On your live stream or market update videos, when people ask questions, do you have a preference on the stylistic or type of questions? Not really. No, I don't think I have a preference. Do you prefer shorter questions, straight to the point? I find that shorter questions that are straight to the point tells me that somebody's done a lot of thinking themselves and they know exactly what their question is. When it's a really long question with a big setup, it seems to be more of a a larger question as opposed to something very specific. So it's some questions are too big, like the one above it. Can you explain taxes for foreign investors at the retail level? That's too big. It would have to be something more specific. As a Canadian investor investing in a U.S. stock that pays a dividend, what are the tax implications? That's a very specific question. This is too big to answer. Do you pay attention to the names of those who comment, ask? Not really. You'll notice that I slide most of it off the screen. I don't really pay attention to the name. They're not names. They're just screen names. They mean nothing to me. If I read the next one, what is it? Fine track. What does that tell me about the person? Nothing. It's not like I'm walking down the street when they go, "Hey, fine, how you doing? How's Mrs. Track?" It's just a name. So not really. I don't really pay attention to it. No. During live Q&A, you mentioned that 9 to 10% is easy with options. Yeah. You aim for 15 to 20. If I worked a full-time job but would like to achieve a return of 15% with capital gains for tax efficiency in the U.S., would you recommend a different strategy? I'm younger, so I don't mind risk volatility. Would prefer much larger returns in S&P 5. Well, so would everybody. So would everybody. Like much larger returns in S&P 500. I think what you're saying is I work full time. I'd like something to earn that kind of money on the side and beat the S&P 500, which is like that's everybody's wish list. If you're not going to do all of the work to identify the targets yourself, you're going to need some source of ideas. I'm always cautious on outsourcing your thinking to other people. You really have to sort of have an idea of what you feel comfortable and what you feel comfortable owning. Turnarounds, leaps, momentum is probably your your best bet. Find like XLK is a good ETF that usually displays a lot of momentum throughout the cycle. Very low dividend, and if you hold it for long periods of time, you can delay that capital gain for a long time. That if you are working full time, I think that's probably where you want to be. And during bull markets, you can sell puts own shares of XLK and sell 20 Delta puts behind it, just as extra revenue. It could be likely that office REITs and apartment REITs have lease buyout clauses or provisions which void the non-cancelable contract. It would be interesting to read a MicroStrategy contract that they sent to customers. Yeah. In the PM introductory video, you recommend to trade what we know. Yep. Having no experience at all in publicly trading securities, I understand it's best to start at the level of the market. Correct. The market, SPY, is a large cap diversified portfolio that holds 503 stocks. So you already have a diversified portfolio. What readings of the CFA program and section of the applied level shall I go over to learn how to make an investment thesis at the level of the market? If you have a long-term outlook, like you're 25 and you're going to invest till you're 65, you don't need to figure out what your thesis is at the level of the market. You just go long, and every quarter you have a rule you have some contribution plan that you're going to continue to contribute, and every quarter you're going to buy how many shares you can get of the market ETF, and you just keep doing that, and you don't have to worry about timing. Having a market thesis is more for determining what sector you would like to overweight. Determining that, we're at a particular part of the cycle. You might, if you're going to rotate through sectors, then that becomes important. But if you're just buying at the level of the market, there really is no thesis for you. 60% equities, 40% bonds, and you have a good diversified portfolio. And then you just keep contributing to it. How can you think about the type of premium you want to sell a put at? You said you were looking to get 110, 120 for your 57.50 puts on July. How do you determine 110, 120 range? Every option has a delta, and every stock has a chart, and you see it sort of weak, and you can sort of figure, well, I think we might get to this level, which is how far down. Given the delta on the stock 0.4, I think there's 50 cents to the downside with a delta of 0.4, which means it should move 20 cents if this moves 50 cents, and if it's $1.05 to $1.10, I figure it's going to go to 125 to 130. If I think there's 50 cents downside, you just can extrapolate what the delta would be. I will say though, I am not as aggressive as I should be, because I just don't believe. I don't believe in the power of this market. I feel I'm going to wake up one day after taking bigger positions, and the market's going to turn around, and everybody's going to be saying, well, we saw this coming, we should have known this was coming, the market was overextended, and all of this and all of that. It's like, well, now you tell me, now you come to the conclusion after I say, okay, well, if you're not going to do what I think you're going to do, I may as well just follow you. I have that sneaking suspicion. So I am much more cautious, I think, than I need to be. Do you know whether there is a way to trade options on FTSE 100 or 250? No idea. I don't trade the UK market at all. Am I right to assume? But listen, it's an index, which means there must be an ETF that tracks that index. And futures contracts that track it. To not have options would be surprising. Am I right to assume that you'd prefer to own long duration bonds over TLT? Yep. Due to duration, not so much for the duration, but because I can get about 100 basis point higher yield by you owning the bonds directly. When rate cuts commence, higher duration bonds will benefit from the greatest upside. Will benefit. Their price will have more upside potential. Sure. Yeah. How important is geopolitics to overall portfolio management? Well, it depends on what it is that you're playing, but it can be. There are two things. There are events and there are trends, right? Whenever there's an event, it's a great opportunity to trade that event. Trends, on the other hand, can persist for a period of time. But a trend that persists for a period of time becomes background noise. Ukraine and Russia, background noise. It doesn't move markets anymore. It's just background noise. Israel, Palestine, probably background noise. The longer it goes on, the more it's just background noise. So it is important, but only really big things are important. If it's geopolitical without any economic or finance fallout, there'll be a small little reaction, and then the market just gets back to things. But for the most part, it's the geopolitics is unpredictable. There are exogenous events that are just unpredictable. So I don't know that I would manage a portfolio thinking about all the things that could go wrong geopolitically. Do you have to be concerned that the dominance of the West is slowly diminishing and dethroned by other economies such as China and India? Those are slow-moving ships. Burgeoning populations becoming increasingly populist. What does that mean? Who cares? I don't understand why that would matter. You'd have to explain to me why a populist India would matter. How are you personally hedging against that possibility? The possibility of what, though? And all its consequences, such as the devaluing of the USD. I don't see that going on. American automakers weakening against China's aggressive stances in the EV space. Where do you see that happening? Mexico's new president and the country's increasing friendliness with China, and what that'll do to American, particularly EV trade. I'm not on board with your statements. I don't know. I can't see those moves on the chessboard at all. I mean, all of those things are big, slow-moving things, and what does it matter if a country becomes more populist in their elections? How does that change anything? I'm not seeing. So what? I guess I would say is so what? The U.S. has been populist now for 8 years. So what? Trump is a populist president. Biden's a populist president. Trudeau's a populist prime minister. I mean, I don't know that changes much. As far as American automakers weakening against China's aggressive stance, how have they weakened? I don't know if you've seen GM share price lately, but they're going to have to come to terms with China on this one, I'm sure. But I wouldn't call that geopolitics. I would call that free market capitalism. And I would call the tariffs on it, government intervention in free market capitalism that is meant to save the U.S. automakers from that kind of competition. So that's not geopolitics. As far as populist governments, I don't know that they have any effect at all on markets. I got a U.S. hedge that I over hedge depending on my expectations. Looking to step up to a full or over hedge with U.S. appreciating, but I'm mindful of all the events this week. How would you approach big events like this from a hedging perspective? I don't know. I don't want to bias whatever it is that you want to try to get done. It comes down to your belief about what you think is going to happen Wednesday. What is CPI going to look like? There'll be the rate decision, I think, is the least interesting. The press conference will be interesting. And then where does the US dollar go after that, with other central banks cutting and the US not? It would be hard to imagine a significant weakening of the US dollar unless inflation, unless CPI comes in really light, and Powell says, the SEP still shows 2 to 3 rate cuts, and Powell is dovish. That's you know, the trifecta there. I don't know that you'll get that. But how you would approach hedging is based on what you think is going to happen, and you would hedge yourself 100% from what you don't want to happen. So if you think, well, the US dollar will weaken, and that is not what you want to happen, you would hedge yourself 100%. But if you think it's going to strengthen and you're long US dollars, then let it strengthen. Yeah, it's all based on your expectations. I intend on increasing the hedging position if CPI comes in hot. Why would you increase the hedge? Let me read this again. You've got a US hedge. CAD is your home currency. So if you say you got a US hedge, it must mean that you are long US dollars. You're invested in US stocks, so you're long US dollars, and you're worried about the US dollar weakening. If inflation comes in hot, the US dollar would strengthen. So I guess I'm not sure well, either way, maybe you're short US dollars, I don't know. It comes in cold, I'd have missed the opportunity if I didn't get before. Is it better to have a formula-like strategy behind this? There is no formula. It comes down to your ability to handicap what you think is going to happen. And if you have no ability to handicap, then you're just gambling, right? Taking out a synthetic position, I'm finding it very difficult to execution on agency synthetics on leaps. The further out you go, the less liquid they become. That is true. Seems like it'd be a lot easier to just sell the individual legs on their own. Well, agency doesn't move a lot. If you wait till 12 o'clock, 12:30, agency moves by a penny at a time. It doesn't move a lot, which means you could probably sell the put and buy the call independently without having the risk of one of the legs running on you. I just got that. One of the legs running on you. Okay, that's pretty funny. You know what I mean. So yeah, wait for a calm time in the market, 12 to 2 o'clock. Maybe not tomorrow because of the type of day it is. But there's always an opportunity. The agency just doesn't move much in the day. Is there an intuitive way to think about day sales outstanding, payables, inventory for cash conversion cycle? Intuitive. I always try to understand and not memorize formulas. Well, days of sales outstanding, figure out what your sales are for the year, divide by 365. That's your sales per day. Look at your accounts receivable divided by the sales per day and say, well, that's how many days of sales are outstanding. Cost of goods sold, divide that by 365, right? Inventory gets charged to cost of goods sold, so you can figure out your days of inventory on hand by how much of cost of goods sold do you incur on a daily basis. That's about all I can say. I think it's pretty straightforward. Same with payables. Payables, you pay for raw materials that you buy, so you'd be using cost of goods sold plus. Well, what else do you have as payables? Some of your other expenses you'd probably have as payables as well, not just cost of goods sold. Depends on the company. I don't know that I have much more to say on that. It just seems. Intuition is something you arrive at. It's hard for me to give you intuition. It's just something you just see what's going on and you just arrive at it. Like for accounts payable, what goes in there? Receivables. Receivables are based on sales, not cost of goods sold, right? So divide the last 12 months of sales by 365. That's how much you sell a day. Let's say you sell $1,000 a day and you have $8,000 in receivables. It's the same as saying, well, that's 8 days of sales, right? TLT is effective duration 16.53 years, convexity 367. Using the approximate formula for change in price, a 1% drop in interest rates, I get 16.55% change in TLT. Yeah, you can forget about the convexity, and you could have just said 16.5. There you are, 16.53. You can just take a shortcut. Looking at the money January 26 TLT call options. Well, at what money, right? Keep in mind, let's draw a chart out of TLT. Let's say it's here, and you're going all the way out to January. This is not at the money. Options are priced on the forward curve. So you have to look at the forward price of TLT for January. That is the 0.5 delta right there. That is the at the money call for January. I know that sounds funny, but the 0.5 delta is the ATM. So if you're just looking at, well, here's the price today, and you're not looking at the forward price, and you're just saying, well, that's at the money, this will have a delta of like 0.65, 0.7 perhaps. So it's going to be expensive. Worth 8.3. Yeah. Does that mean the January 2026 calls pricing just around 100 basis points of rate cuts? Well, what's 16% of 92? Do I have a calculator here? 92 times 0.1653 is 1520. You're going to pay 830, so no, it's not pricing in. Looks like it's pricing in 50 basis points, but it's really not pricing in 50 basis points, right? It is 1 plus R to, where is it, January, and we're May, June. So 6.5 months, 6.5 over 12 minus 1. Actually, 6.5 over 12, and that's your spot price. And we can say R minus the dividend in here. So you're priced on, you have to figure out what the forward price of this is. If this is 92, there'll be some forward price. And that forward price is where the 0.5 delta would be. The higher the interest rate, the more expensive the current at the money would be. The deeper in the money it would be based on January's expiration date. If interest rates were really low, then yeah, 92, if you go to January, the 92 would probably have a delta very close to 0.5, maybe 0.54, 0.55. Why is it that stocks and bonds are positively correlated in inflationary periods? They are not positively correlated in inflationary periods. There are two types of inflation. There's demand-driven inflation and there's supply-driven inflation. If you have supply-driven inflation, both stocks and bonds tend to move down at the same time. If you have demand-driven inflation, stock market goes up while bonds go down. You tend to have a negative correlation. This is the most popular type of inflation. We had supply-driven inflation, not demand-driven inflation. And even in some sectors like housing, the inflation there is still supply-driven. Swiss investor, anything you consider before opening a position on cap rate? I don't think you can. Regarding taxes and FX exposure, I don't think you can open a position on cap rate being outside of Canada. I rarely hear you talk about leaps. Do you use it? Yeah, sometimes. If I'm doing like a long dated synthetic, so for synthetics, you don't want to use monthlies. But the higher interest rates are, the more expensive it is to do a leap. Because again, you're being priced out on the forward curve. So if the price is here, by the time you get to the future, especially at a high interest rate, if you have a 1-year rate that's sitting at 5.25%, the cost of carry increases the forward price, and the options are centered around the forward price. So the higher the interest rate, the less desirable leaps become because you pay for them. You have negative carry when you're buying leaps. Significant negative carry. How appropriate is to contact you via email or LinkedIn rather than commenting on your YouTube? LinkedIn, I guess. I don't really answer a lot of questions that I get in email. I used to get a whole lot more than I get now, to the point where if I tried to answer them, it would be my whole day. There was just simply no time, and there was no time. And sometimes I'll get requests on questions that require me to do half an hour of research first and write out a long I'm not going to do that. I've had people send me their homework assignments saying, can you answer these 4 questions? And it's like, come on, man, like, come on. So brevity, right? If your question lends itself to a 1-sentence answer, I'm more likely to answer it. But if your question requires me to write out thoughtful paragraphs and look things up and do some calculations for you, I'm more than likely not going to do that. I just don't have the bandwidth to start doing that kind of thing. LinkedIn is an easy place. I don't answer every question I get, again, because if your question requires a lot of effort on my part, I just don't have that kind of time, so it might be better here. How would you maximize the chances of one becoming a great equity research professional? Maximize the chances. I understand it's all individual. However, clearly there's a similar pattern behavior to established professional where he is today. It's called putting in the time. Period. In anything you do, it's called putting in the time. Look at any Olympic medalist. What did they do? They put in the time. Hours and hours and hours and hours. Anybody who's at the top of their profession, ask them how they do it. It's putting in the time before you get to that level. And it is, quite common that when you see successful people, a lot of people envy what they have, but they don't envy how they got it. The pathway is not enviable. You do have to sacrifice. It is a career. It is a calling, and it is putting in the time. There is no shortcut. No shortcut. And that's it. That's the secret, is putting in the time. Let's see. Interface question. Would you consider posting market outlook videos on mobile app? I spend considerable time consuming and often try to listen in, and YouTube is not great for that. YouTube doesn't. I thought YouTube has mobility, right? I have the YouTube app. It works well. YouTube has an app. I'm not sure that taking it off of YouTube and putting it onto the app would be any different. So, yeah, I'm not sure how that would be any different. I don't know that I could suddenly make your screen bigger. I mean, if that's what you're concerned about, I don't know that I could get that done. So, I think that's something that there's already a solution for. What do you think the effect of Treasury buyback program will be? If you didn't know what was going on, you wouldn't know what was going on. I think that's probably the best answer. In theory, it should drain duration from the market and raise liquidity. But I wonder the effects on the different asset classes. The amount that would be considered for the buyback based on the total amount outstanding is what an accountant would call immaterial. So I wouldn't even look, other than it being something operational the Treasury is doing, I wouldn't look for any kind of effect anywhere. In fact, if I said, watch the Treasury market, something is going on, watch it very closely, after a couple of weeks, you'd say, I must have missed it. Yeah, that's, you blink and you'll miss it. I don't think it's going to have any effect that is going to be noticeable in financial markets. Excuse me. If a deflationary move settles in, deflationary, that's bold. In theory, we should expect the long end of the curve to come down. Yep. Corporate spreads to go up. Well, yeah, I guess so. Which of these two forces should prevail in terms of pushing corporate bond pricing up or down? Depends on the spread, the size of the spread. So for high yield, you'd probably have a drop in prices. For investment grade, that would be it would be hard to determine which is the greater effect. Are you interested in looking at these new happenings in Europe with European elections? I know nothing about anything other than the U.S. I know nothing. All I would know about it is what I hear in the news. But other than that, I have no well-informed opinion or belief about any of this. You mentioned in your live that you're replacing selling puts on T with Oxy. What strike price and days to expiration are you currently selling puts at? I said it in the market outlook. I sold $60 puts on Oxy for July. In the case that the shares are put to you, do you typically just sell covered calls on them until exercised? It depends. It depends on what the underlying is. Some maybe, but not always. It really just depends on what it is I'm trying to get done. 2 questions unrelated to this week's market outlook. Curious about your findings in your PhD thesis you mentioned in one of your previous videos regarding innovations across economic cycles. Could you share additional insight on your findings? What I did was I took the top 1% of highly cited patents, which are typically the most significant innovation because a patent is created and then any follow-on patent cites this one. So the more citations, the more significant this one must have been in terms of being not just incremental innovation, but radical innovation. Then I looked at the business cycle and I took these 1% and I said, well, where did these happen? And I plotted them on the business cycle, and here's what you find. Is they happen in expansions. That the belief was that in recessions, this is where companies then change what they're doing, or they reinvest in new things and new products and new markets because existing markets have become saturated. The belief was that all the big things happen here. They happen here. They happen up here. Right when the central bank comes in to crush these things is right when they shouldn't, because this is where the hotbed of innovation is happening. Big innovations that have a lot of follow-on after the fact. So they all happen at those points in time. You mentioned that you've taught a course in entrepreneurial finance and the importance of cash flow accounting for companies. Is this something you would consider adding in the applied series? I don't know that it would be of any use in the finance world. It's for startups. So let's say that you can sell a product. It costs you $50 to make a product and you can sell it for $50. You would think, why would I do that? It's because in the early stages, you're really just trying to prove the market. You're not really trying to be profitable. You could say, well, if I made 100 of them, I can make them for 40. And then when I sell this one, I'll sell it for 50. But making 100 requires a lot of cash. And you're not running a business for profitability in the early stages. You're running it for cash. You got to preserve cash flow for as long as possible. So you're really just trying to prove a market. You may not even be profitable on every item you sell, but that's because you haven't scaled up. You know that if you scaled up, you can drive costs down, but you must first prove the market. Once you prove the market, you have to show that you can be effective. Once you're effective, then you start working on being efficient. But there's no point in being efficient if you can't be very effective, right? So you just manage for cash, but I don't know that that is very useful in what we're doing here. But no, I don't know that I would put that in the applied series. Arbor's 10K. We finance our structured finance investments primarily by borrowing against or leveraging our existing portfolio using the proceeds to acquire additional mortgage assets. Does this mean ABR can only leverage using portfolio assets that haven't been sold? Well, yeah. I mean, you can't borrow against your house if you've sold your house. You can't go to the bank and say, I'd like to borrow against my house. And they say, where do you live? Say, oh, I sold it last year. I'd still like to borrow against it, though. I mean, yeah, you can only leverage assets that you haven't sold. I mean, yeah, unless I'm missing the point of your question. Once you sell something, it's not yours. You can't borrow against it. If ABR decides to sell its portfolio, either as MBS or private label, wouldn't be MBS. I think you might have a misunderstanding of what ABR is doing. Does it pay back its borrowings in full using the proceeds from the sale? Well, it has to, yeah. So it can borrow again for another asset. Yeah, I think you have a slight misunderstanding of what's going on with Arbor. So Arbor originates loans, and it will lend money to a company. So it lends money, and it has a loan on its balance sheet called a bridge loan, right there. It's called bridge loans. Well, they need cash to finance these loans, so they borrow to finance these loans along with some of their own equity. So on their balance sheet, they may have, let's say, $12 billion, and against that, they might have $7 billion of borrowings, but they've collateralized maybe $9 billion against the $7 billion, so that have $3 billion unencumbered. Maybe there's an opportunity to issue another $500 million in loans. They would borrow against this and collateralize this to get it done, again, along with a little bit of equity in there. That's all they're doing, is borrowing short and lending long. And it helps when you do that. If you have an upward sloping yield curve, then it works all day long. They can engineer an upward sloping yield curve, because even if they're paying 5.5% on their cash over here, they are not charging the 10-year yield. Even if you have a curve that looks like that, they're not charging the 10. They're charging a spread above there, so they might be 12 to 15%. So they can still engineer their own upward sloping yield curve. But they're just lending money. They're kind of like a shadow bank by doing that. What aspects do you think make Arbor a good investment option compared to its competitors? For example, compared to WD, which originates significantly more loans to Fannie. Well, I don't know that it's significantly more. What did they do in the last year? Just under $1 billion? What did Arbor do? 500 and 600 million? I don't know if it's significantly more. I think they're not profitable. Arbor is. I think they showed a loss on their last statements. Arbor hasn't. Valuation is probably another issue I'd point to as well. But I've not done a deep dive on WD, so other than some obvious things, I really haven't done a deep dive on them. Why would employment change greater than forecast be negative for REITs? Anything that affects interest rates will be negative for REITs. So if we think interest rates are not going to go down as quickly as we thought, that would be negative for REITs. Is it because Fed will not cut rates due to strong employment? Probably. The thing that's going on now is in the Canadian market is you have a June 25th date. Capital gains, 50% inclusion, 66%. So if you have a capital gain, it is worth taking it now, because then you'll only have a 50% inclusion. So you're going to have, usually this is reserved to the end of the year. But now you're getting it for June 25th, is you may as well take what capital gains you have now. Take your capital gains now, take your capital losses later. So if you sell on June 23rd, you got to sell by the 23rd to settle by the 25th. And you have a capital gain, the inclusion is 50%. Anything you have a capital loss on, if you sell June 26th, if you got 66% inclusion rate on gains, it means you got 66% inclusion rate on losses, right? So there is a tax arbitrage here. Take all of your gains before June 25th, let your losses go till after June 25th. So anybody with any gains in any of these, any Canadian stock right now is probably crystallizing those gains to pay the 50% tax on. And then maybe getting into the stock in 30 days or 60 days, whatever the wash rule is. So there is extra selling going on, I think, because of that deadline for the capital gains inclusion. Could we have a situation where interest rates are falling, but mortgage renewal rates are rising? If yes, what would be the cause of that? Interest rates are falling. Yeah, so interest rates in Canada are tied to the 5-year. In the US, they're tied to the 10-year. So let's draw out a yield curve. And here's your money market curve. And we have an inverted curve right now where the 5-year is lower and the 10-year is lower. You could have a situation where the Fed lowers money market rates, but the long end of the curve does this. It flattens out so that the 10-year goes up, which means mortgage rates would go up while interest rates, money market rates are coming down, because the Fed only controls the overnight rate. This is all market driven, right? So this is up to the 1 year. And then, so that's capital market rates. These are money market rates. Money market rates reflect the overnight rate from the Fed. So you could have rates that are lowering, and the long end of the curve decides to swing upwards, and the 5-year in Canada goes up and the 10-year in Canada goes up while the short end of the curve is dropping. You could get higher mortgage rates while interest rates are dropping. Yeah, you could. Could bond market behavior influence such an event? Yep. Well, when we say could bond market behavior, it would have to be bond market behavior that influences that. In Applied Series, the PDF files are updated with a lag. Yes, they are. We get new videos when I go to download the new PDF file. The recent screens aren't in the file yet. Can files be updated more frequently? I am not in control of the speed at which things get done at all. And I seem to think that I can't hand my screens in till I narrate, because as I narrate, sometimes I say this doesn't flow and I change my screen, or I notice an error on the screen where I say, oh, that word is spelt wrong, or hang on, this is in the wrong place, or that's the wrong number. So I must narrate to get the final version of the screens. Then I send the screens in, but the video's done. So I don't know when the PDF will be done, but I think, well, why hold back the video? So I just post the video as soon as it's done, and I know the PDFs will be coming along at some point, so that anybody subscribing now would have all the PDFs for all the videos that are currently up. But if I put one up tomorrow, yeah, the PDFs might take 3, 4, 5 days to get done. I am not in control of that. For now. Let's just leave it at that. For now. I would appreciate if you mentioned the new videos you were working on for the sector studies. I posted on LinkedIn today what I should do next. I said trucking, ocean shipping, I said railroads or trucking. And I think I got 1 vote for railroads, about 6 or 7 for trucking, but overwhelming was ocean shipping. So I'm going to work on ocean shipping, and there are 2 types of ocean shipping. There is dry bulk, and there are tankers. All right, so there's wet and there's dry. So we'll look at both sides. Tankers are really simple, pretty much oil. That's pretty much it. Dry bulk is everything else. So we'll look at that. The reason I chose this is because the container that you see carried on the ships, that are really stacked up really high. These containers, when you get to a shipping yard, these containers come off and they go onto a truck, the flatbed part of the truck. And then they get taken to a rail yard, then they get picked up, and then they get put onto the train. When they get to another destination, they get picked up and they get put onto another truck again. It's all the same, it's the same shipping container. So it is one long ecosystem. Understanding shipping, understanding trucking, understanding railroads, it's all the same container. They're just being transported over different mediums, but it's just the same container moving all over the world. Are master limited partnerships in your investing universe? Not really. What is your opinion in favor or against having them in a portfolio? I have no opinion either way on them. My understanding is that they are valued using price to sustainable free cash flow metrics, which is comparable to net asset value for REITs or tangible book value for MREITs. It should open nice opportunities for an income factory. Well, yeah, I mean, do they have options? And can you sell options on them? Yeah, I don't know. I'm going to pass on that one. I just don't know enough about MLPs. Any mistakes that you made as a trader or investor? Oh my God, any mistakes. Every single mistake that can be made, I've made, and I still make them. What lessons did you learn? Too many to mention. You know, the lessons I've learned are I can sum up, I guess, in 2 or 3 big ones. Trade what you know. If you don't know anything about something, stay away from it. So if Kramer screams buy on TPQL plus or whatever, I don't know, and you know nothing about it, don't touch it. All you're doing is outsourcing your thinking to someone else, and you don't know anything about this. Don't trade what you don't know. If you know nothing about it, don't touch it. The other one is patience, right? Patience. Most of what happens in a day is noise. The stock moving up and down and trying to figure out a reason why, it's all noise. What you want to do is you want to think about the trajectory that it's on, and stocks will do all sorts of things while it's moving in that trajectory. As long as you have that trajectory in place, you know, it'll do all this kind of stuff. Well, these represent buying opportunities. If you're day trading, good luck, man. Timing the market is brutally difficult to do. And the shorter your time frame, the more impossible it becomes, the more you're gambling, the more this becomes a casino. Don't turn it into a casino. If you do, go to the casino. Just go to the casino and bet there. Patience, trade what you know, right? Successful trading, your hands should rarely touch the keyboard, right? In the course of a week, if you figure out how long were your hands on the keyboard, it should be a span of maybe 15 minutes throughout the whole week that your hands were on that keyboard. If you're doing 50 trades a week, you're doing it wrong. There aren't 50 opportunities in a week. And if you do think that you can find 50 opportunities in a week, you got a staff of at least 10 to 12 to come up with 50 opportunities a week. You're not going to do it yourself. You're just gambling. Trade what you know. If you don't know it, educate yourself. Once you know it, then it's on your list. Trade what you know and have patience. That can solve a whole bunch of problems, especially the trade what you know. Question about CRA non-resident status. I thought to become a non-resident in CRA want us to cut off all ties. Not all ties, but substantially all ties. You can't cut off all ties because if you've worked in Canada, you do get CPP. You can't cut off that tie. You will always be a Canadian citizen. You cannot cut off that tie. Just because you're not a resident doesn't mean you weren't born in Canada. You'll always be a Canadian citizen. If you have a TFSA and RRSPs, you don't have to close those. You don't have to shut down those ties. If you have a house, you don't have to sell it. You can keep it as a second house. It is no longer your primary resident, so there is a tax issue there. So let's say you've lived in your house for 5 years and you move out of the country, and 2 years later, in year 7, you sell the house. You have to have a valuation done when you leave the country. You had a purchase price, you have a valuation. That is your capital gain because you lived there as your primary resident. What you sell it for here, this is a taxable capital gain. That is taxable. This is not taxable. That's how that works. But no, you don't have to cut all ties. It's impossible to cut all ties. To make the case with CRA, the more you cut ties, you close your bank accounts, you give your driver's license and your health card back, you do close your TFSA, even though you don't have to, but you do. The more you do, the more it proves to CRA that you truly are gone. But to prove that you truly are gone is just to demonstrate that you have not been in the country for 6 months plus a day. You just need some other country to allow you to stay there for 6 months plus a day. And it can't be 2 months here, 2 months there, 2 months here, 2 months there. Okay, 3 questions. Why do you stand back on a red date and wait till later to sell puts? I don't. When there's sell off, I do sell puts selectively. I don't take full positions, but I do sell puts. Going through your Iron Condor Butterfly video on AL, why would you avoid options less than 15 days? Isn't the decay highest? Yeah, but the return for the capital you're putting up sometimes just doesn't justify the risk of it. I prefer, 30 to 45 days. That's kind of like the nice place to be with higher probability of being right. With 15 days left, there's typically not enough premium in it. I'd have to do a lot of options to get the premium to make it worth it to move the needle based on the size that I have. And I don't like the gamma risk. What would you hold in your TFSA from a distributions corporate tax perspective? TFSA, REITs, assuming this is the 40% of the 60-40 buy and hold active portfolio. Trying to rebalance to optimize tax efficiency. Canadian REITs, there you go. There you go. Income generating strategies, selling puts. Are you mostly relying on margin while otherwise being fully close to fully invested? Other securities in your portfolio will act as margin. If you have T-bills, which at 5.5% you should, that acts as margin. What, in your view, is optimal approach for maintaining cash balance for running the strategy? The word optimal, I think, is overused, being that you have no idea what tomorrow is going to be. There is no possible way that you can have anything that is optimal. So the better word here is effective. In your view, is an effective approach for maintaining a cash balance? I think I covered this. Limit the amount of theta decay per day that you're willing to take on. I mean, once you start selling puts, you sort of get this idea that more is better, but you can't be greedy. So you have to determine, whatever portfolio value I have, what am I going to multiply it by? For beginners, I'd say multiply by 0.001. That should be your theta per day. As you get better, you can get to 0.5 and even 0.01, which is aggressive. But I don't know that I would, start at 1%. Do you hedge FX exposure when you buy securities in other currencies? Sometimes I do. A lot of times I don't, because I typically in my portfolio carry both Canadian dollar and US dollar balances. So I typically use the US dollar balance for US positions, and I don't keep changing it back into Canadian. When I feel that one currency goes to an extreme, then I'll put on a position that doesn't really convert one into another, but hedges out the position, whether I think the Canadian is too strong or the Canadian is too weak. So we're at 137.6 right now. Depending on what happens with the Fed on Wednesday, if I see 139 to 140, I would probably at that point sell the U.S. in favor of the Canadian, which means I would hedge out any U.S. exposure into Canadian. Hedge, not convert, just hedge. What scenarios would you prefer to gain exposure to a stock ETF by buying long-dated calls as opposed to selling puts? Low interest rate environment. The higher the interest rate environment, the more expensive those calls will be. It would depend on how high volatility and thus premium is. Yeah, it would depend on that, but usually when volatility is high, you should be selling options. When volatility is low, you should be buying. If you were elected the U.S. president this fall, what would you do to combat the overarching federal deficit spending and magnitude of debt? Would you increase government income through No, I wouldn't. I wouldn't increase any taxes any longer. I would cut spending. The idea that that you can't find ways to make government smaller is unimaginable. What you need is a business executive and I know you think Trump is, but he's really not. He's a self-interested individual. I mean, I'm talking about somebody who treats the U.S. Like they're the CEO of a company they don't own. And you need to rationalize that you can't cut these departments, these government departments by 20%, cut staff by 20%, and increase customer service levels. It would, to me, would be shocking if you can't find 20% to cut in some of these departments. So it's just cut. You got to cut, plain and simple. But nobody gets elected by saying they're going to cut spending because that's the state of democracy now. If you want to get elected, you got to promise this group of people money and this group of people money and that group of people money, and that's you got to buy your votes. Looking at OAS spreads, why is IG increasing more than high yield? Oh, when you have 3 to 4 to 5 basis points, I don't know that I would read anything into that. Can we get more oil and gas outlooks? I've done those. I've shown you where to find the data this week. This week in petroleum. The idea behind me doing these things is to show you where you can find them, so that you don't need me for those particular things. But given that supply seems to be increasing in the U.S., it may be time to look at where we are in terms of inventory. Interesting thought in my mind, and want to see if you can come up with a theory or experience to support it. If market went up while rates increase, why should investors believe rate cuts would push the market higher? Weak economy and output. Well, if you're getting rate cuts because of weak economy and output, you have to think about expectations, right? If the economy seems to be weak and you're getting rate cuts, the market will expect that to spur economic activity, and then they'll buy ahead of that, ahead of the economic activity showing up. Assume Fed will cut some point this year. At the beginning of the rate increase cycle, I believe S&P will hold back, but it went north and rarely came down. Now the rate cut cycle begins. Should I think the market to go south? Trying to predict which way the market is going to go on these sorts of things, I don't know that there's a lot of value in that. The market's going to do what the market's going to do. I don't know what it's going to do. If you cut rates, will there be a rally or will there be a sell-off? Beats the hell out of me. I mean, you could make... I don't even know if you need to make the case both ways. You can just imagine it, right? Sometimes I have no idea what the market is thinking. And the market will do something completely unexpected, and you'll think, well, I don't understand this move at all. Who the hell knows? I've long ago abandoned predicting, on this event the market's going to rally. I just, it could. So on Wednesday, if inflation comes in really hot, the market naturally should sell off. It should sell off because the expectation is, well, there'll be no rate cuts this year. But it could rally, in which case you would look at it and say, well, I didn't expect that, but there's been a lot of things I just don't expect, and they happen. So it would be one of those things that, well, why is the market rallying? And then you're coming up with an answer for after. It's like, well, because inflation is hot, which means prices are still going up, which means companies are still charging more to their customers. And the demand is still really great, which means it's earnings will grow faster and the interest rate's not going up. It's just going to go sideways, and earnings will now grow faster. And who knows? Who knows what the interpretation is going to be? I haven't got a clue. All you can do is control what you would do. I don't know. If they don't cut rates, the belief is that the market would correct downwards. If the SEP comes out and there are no rate cuts this year, the belief is that the market should correct downwards. But The rest of the market might say, well, no, that means the economy is so strong right now. If the economy is strong, earnings are going to be great. And up we go. I don't know. Beats the hell out of me. It is unknowable. So if I told you the Fed is not going to cut rates tomorrow and inflation is going to come in slightly higher than expected, I don't know that that would be enough to know whether I would short the market or buy the market. It would be like, well, I don't know. It's still a coin toss. I mean, I don't know. That's not clear. So who knows? Who knows? It's trying to make sense of the day-to-day moves in what is otherwise a random system. Day-to-day random. The price moves are largely random. In a complex adaptive system, prediction is brutally hard to do, especially over shorter periods of time. Where are we going to be in 10 years? Higher. I mean, there you go. That's about the only thing I can tell you. I shouldn't say in 10 years. Sometime within the next 10 years, this market will be higher than where it is now. Can someone explain to me why our current economic situation isn't considered to be a recession yet? There is no economic indicator that suggests you have a recession when economic growth is positive. What's the objective cutoff to say that we're in a recession or that has passed? Negative growth, contraction in economic growth is the key for the recession. Keeping some 100,000 US with IB accumulating since 2019. Occasional trading. That's a lot to be sitting around. I received an email from IB requesting me to close my account due to compliance costs and de minimis value. Did you write it outright? 100K US or $100 US? De minimis value. I don't know why IB would give up lending your 100,000 out. The IB doesn't pay you the market rate. You got 100,000 sitting there. IB does invest overnight. US dollars are getting 5.5. They're paying you what, 4.3, 4.4? They're making a free 100 basis points on your money. I don't know that they would close it down due to de minimis value. Still able to open long positions, but I suppose they will disable it very soon. I don't know what's going on there. No better strategy other than sending emails seeking solutions, so I sent them a message offering to close compliance gaps by providing any further information they may need to keep my account running. I've never heard of that before. Been topping my EB account while I was living in Russia. You buried the lead. Why didn't you lead with that? Russia. Yeah, Russia. So there's probably some ties to your account, with Russia, and now it's been flagged because of that. So you'll have to do some work to convince them about something. You should have led with that. Yeah. Okay. Don't bury the lead. It's like saying, I don't know what to do. There are police in my house. They've been here for quite some time. They're threatening to arrest me. And I've tried to explain about the dead body in my closet, and well, maybe you should have led with that. That would have cleared a whole bunch of things up if you would have led with the dead body, right? If you would have led with Russia, that would have helped. Bull put spread video. You insisted it's not a good strategy and one is bound to blow up in the long term. I don't think I said that. I said if you have a whole bunch of these, like if you load up on these, at some point, if you have a whole bunch of these, markets do correct. And if they do, they'll blow right through past all those spreads, especially the tighter you have them to at the money. So be careful. You don't want to be just on one side of the market. But I don't think I said using them, you'll blow up. They're defined risk trades. You can only lose so much. Isn't it better compared to naked short put, as risk reward ratio is even worse in short put? With the spreads, you're basically committing to holding them to expiration because you're long and short. So as one makes money, the other loses money. So you are almost committing to holding them right to expiration. I find that you don't have as much optionality with that. So I only sell puts on stocks I want to own. Like I don't do it speculatively. I know that you know, there is some people that will sell puts, you know, 20 delta puts on a whole bunch of things, and then they just follow rules about when they close their options, and they look to be right more often than they're wrong. I'm not a big fan of that, although that is, you know, that is the strategy. I choose my underlyings very carefully. They're underlyings that I would own anyways, which allows me to be a little bit more aggressive on the deltas if I want to, because I don't mind owning them. I could be more aggressive, but I just don't like the market we're in. I don't like the multiple. I don't like 21 times forward earnings. I don't like the longest curve inversions we've ever had. I don't like rates elevated and, you know, no cuts basically in sight for quite some time, with real estate under a hell of a lot of pressure, right? I mean, that's usually the first, you know, if you're looking for sectors that hurt the first, it's always real estate. With a whole bunch of private equity behind real estate and a whole bunch of private credit behind real estate that we don't know the extent of, with an inverted curve, right? So, you know, I just don't like where we are. So yeah, I could be more aggressive, but not in these environments. But no, I don't think I said you're bound to blow up in the long term just by using a bull put. It's just that when you start using them, they require so little capital. People tend to do a whole bunch of them because it sounds like free money. And if the market turns, they all blow up on you. My question is, isn't it better? Okay, I already answered that. What do you think about seeking alpha analysts? I don't know. You mean overall? I think like any group of people, it follows a power law, that there's probably 10% of them that are really good and 90% that are average and maybe even less than average. But probably 10% of them are pretty good, and probably 10% of them tend to have almost all the followers. Is it a legit way to gain experience in investment research? Well, I mean, take out the word legit. Is it a way to gain experience? Sure. I don't know if I would call it legit. Do you respect any analyst? I don't know any of them. I don't know any of them at all. I've read some things on Seeking Alpha, like just a few, only because you get it through Interactive Brokers, that you can read some articles, and some I've read are okay. Well, that's insightful. Others I've read, I can almost dismiss, you know, a couple paragraphs in. It's like, okay, I'm done with this one. But I can't remember any of the names of anybody, or you know, like don't listen to this person. They don't know what they're talking about. But yeah, I think it's like any large group of people. Is you're not going to have superstars. You know, if you have a group of people, they can't all be superstars. Same with any corporation. They're not all superstars. You take any corporation, you're going to have quite a few of the people in there that are just average people doing average things. In any large corporation, it'll have a lot of average people. That in any corporation, any group of people, there's a power law that, you know, again, 10% of them are probably really good, and the other 90% are, you know, average people doing average things. Couldn't help but notice a large concentration in SPY to 3 companies. Yep. I think the market will continue to be driven by the AI story and build out. Nvidia will trade post-split tomorrow. Does further money come in and continue the rally? Maybe money that was in Tesla will reallocate to Nvidia at more attractive share price point. Especially since Tesla has been such a laggard over the past year and today too. I was hoping you would cover the upcoming Tesla shareholder meeting on Thursday and your thoughts on the outcomes of Musk doesn't receive his pay deal. I think Tesla's better days are behind it. I think, you know what this reminds me of a lot? Go back to Research in Motion when it was at the peak and the CEO was trying to get an NHL team in Hamilton. Like, his attention was just being distracted from the company. His interests were elsewhere. The whole thing just sort of fell apart. This is what it reminds me of. Is a company whose upgrade cycle is late. It's too long. The competition has already passed them by. Tesla is no longer number one on any feature that you can name. It now has to exist in a market characterized by overcapacity, especially in the EV sector, and it has to compete against Chinese rivals that are just as good or better than it is on almost every count, including self-driving. They are not the 2 years ago the recognized leader. Today, not really. So I think its better days are behind it. I think it's a Research in Motion stock. I think in 4 or 5 years, this company will be a shadow of itself. I would say sub $30, $40, $30, going to $20 a share. But I think its better days are behind it regardless of what it does at this point. Its mojo is lost, if you want to say it that way. As far as the rest, there's more and more evidence showing up that this generative AI, while being a good leap forward, is simply just not ready for all of the applications that had been promised would happen, and all of the things that it had promised, that there was promise of it doing. It's simply just not ready in that sense. There was the example given that it can write code a lot faster, that a senior developer doesn't need junior programmers because it can write some code a lot faster. That's been going on for decades. I forget the name of the governor in the last election. He body slammed somebody. He body slammed a journalist. I don't know if you remember this guy. He originally started a company where you could, on sort of like a blank canvas, just draw, lay out your web page, the kind of web page you would want, without knowing any code at all. You could just lay it out, and then the program would generate all the code for you. And Microsoft bought it from him. I think it was like $600 million. And they called it Front Page. So, I mean, that was in the 90s. You could use Front Page, and you didn't have to know any HTML at all. And you could just lay out what your web page would look like, and it would just generate all the code. So the idea of algorithms generating code has been around for a very long time. The idea of predictive analytics has been around for a very long time. What is called predictive AI. It's not called regression anymore with predictive regression. It's now called predictive AI. That's been around for a long time. It's the generative part, but more and more we're starting to hear little stories here and there about that it's just not ready for prime time. That yes, you've had this big leap forward, but it's really just not ready. So it might lose its velocity if more of this goes around saying, you got all of these people working on all of these large language models, and there is an inherent limitation to what you can get done. No matter how many layers you have, there's just this limitation. It's just not quite there. We need another big breakthrough. So you've already, technology doesn't just do this. Technology does this, and then it'll go sideways for a long time. Then it tends to make a leap, and it goes sideways for a while. Then there's a breakthrough, and then it goes sideways, this kind of thing, so that you have the idea that it's this linear thing. But sometimes you'll get a breakthrough, and you'll go sideways like for 20 years before you get another big breakthrough. And I think OpenAI gave us that big breakthrough, and now, I don't know that you're going to keep getting these big leaps in the generative part. I think you got a big leap forward, and now you have to incrementally innovate on that until you get the next big breakthrough. And again, there's more and more evidence. Almost daily, you're hearing more and more about, this isn't really worth the investment. To pull back an investment here. I think it was telling that Apple is going to use OpenAI. Apple is typically not a kingmaker. Very rarely have they ever been a kingmaker. They do and own everything, but not this. They abandoned the car and, gave this over to OpenAI because I think they've sort of figured out that, this stuff isn't ready, and we could spend billions and billions on something that's 80% there. But the could be that, the state of the technology is 80% there at this point in time. Barring a big breakthrough somewhere, it's not that we can get in on this thing and get to our 100% because it's done. It could be that there is a serious limitation on these neural nets, and this is as good as it gets for now. It could be. And maybe they've decided that, we can't create something that's 80% there. We're 100% or we're nothing. And maybe they've already arrived at the conclusion that it's not 100% and it won't be for some time, so why should we spend the money on it? So I don't know about the market will continue to be driven by AI story and build out. This could easily fall apart. Default risk on these convertible bonds seem way too high and at zero interest. Yeah, well, I don't know about default because the company can always sell its Bitcoin. It will have to sell more and more Bitcoin if it has to meet the bonds when they come due, or it'll have to sell more and more shares. There just is no upside. There is no leveraged upside to this story. If you believe in Bitcoin, you're better off buying a Bitcoin ETF. MicroStrategy is not your solution. But I was reading today that a whole bunch of there's like a handful of, I shouldn't say a whole, but a handful of other companies that have decided to use the Bitcoin Treasury model, saying rather than holding cash on our balance sheet, all of our extra cash instead of marketable securities, we're going to put in Bitcoin, and all of those stocks got like 20-30% boosts in share prices from the time that they announced it. So you must have a really stupid group of people out there that are in the Bitcoin space or in the crypto space. These have got to be boneheads, absolute boneheads, in which case I would say, why not take their money from them? Like, why not? Why not start a company? Who cares if it makes money? Do a SPAC and just announce that your treasury model is going to be Bitcoin, and then sell your, give it some time and then sell your shares to the stupid people. I mean, if they're willing to pay double and even triple for something they can get in an ETF, right? This market is led by companies full of cash. Could it be that they are the immune ones from interest rates as they can get rid of their debt at their convenience? Well, they can get rid of their debt at their convenience. Sure, they've got cash, but they've also got either fixed rates at really low rates, especially investment grade companies that have 12-year, 15-year debt that they locked in at 4.5%, 5%, some even at 3%, right? For the time being, they are making more money in money market funds than the interest they are paying on debt. True. Russell 2K is flat year to date. That's because like 35 or 40% of the Russell is unprofitable. I believe shorting per se without assets to hedge is a mistake given that composition. I don't understand that last sentence. So Do you see radical changes in areas like trade, energy, or other areas with recent far-right escalation in Europe? Nope, I do not. I do not. The economy is the economy. Politics is ideology. So what did you have during Trump? You had a market that went up, and people would say, well, Trump was far right, and you had a market that went up. Then Biden came in, and wokeism exploded, and the market went up. And Trump will come in, and the market will go up. We had, the wokest of the woke here with Trudeau. I say here, like I'm still in Canada, with Trudeau in Canada, and TSX went up. Ideology matters little, other than it just rips apart the social fabric, but the underlying economy is the economy. You can hate your neighbor because they vote a different color, but you're still going to go buy your iPhone and head to the mall and pick up Starbucks on the way home. Right? It's not going to change what you buy. It's just going to change who you buy it with. You're not going to go with that person who voted for Trump, and the other person's certainly not going to be seen with somebody who votes for Biden, but they're still going to be in the mall avoiding each other. So no, I don't see radical changes. You've still got to get this stuff through. You've still got to pass all this stuff. You still got to write the legislation. You still have to think about getting reelected. You can't just, once you win, you can win on a whole bunch of promises, but once you sit in that chair and you have that office, you don't want to give it up. So then you got to start thinking about, well, if we do this, it'll be unpopular, and if we do that, it'll be unpopular. So let's do the popular thing, because you don't want to give up your power. Please do the silver market. I've done copper and gold in the applied series. Silver is just as easy to figure out. Everything that applies to copper and gold in terms of resources versus reserves, as far as the type of mining that you would do, as far as the type of, whether you're producing concentrate or a leaching or through some kind of acid leaching, all of it applies. It's just a different metal, but all of it applies. It's the same thing, just a different metal. And you say SOMA isn't counted in balance sheet runoff. Never said that. Most of balance sheet runoff is the SOMA. Can you explain why the Fed is up 68 million? Oh, I see what you're saying. So you have the Fed balance sheet. One of the assets on the balance sheet is the SOMA, which holds a whole bunch of securities. So if the SOMA is down 35 billion, and the balance sheet is down 40 billion, well, it's down 5 billion for other reasons other than the SOMA. So in the last week, once you remove what the SOMA dropped by, there was a net increase in the balance sheet of 68 million. Why? I don't know. There's a whole bunch of other accounts on the balance sheet. Could be the Treasury balance went up 68 million. Could be something went up 5 billion, another thing went down 4 billion 900. There's a whole bunch of accounts on there. Could have been a change in a whole bunch of things. So there is no one why. It's, well, first of all, $68 million on a $7.3 trillion balance sheet is the smallest of the smallest of the smallest of rounding errors. It's like saying, I only have $2,563.22. I thought I had 21 cents. Where'd that 1 penny go? You just wouldn't care. It's so small to be insignificant. Who cares? Bit confused by the AL promotion. If we have passed a CFA exam but are not subscribed to your site, we have to wait until after July 1st to get the discount. Correct, because it has to be coded, right? I can't just say, here you go. There has to be something to click on, and there has to be something to verify that you do in fact have some CFA standing, and there has to be a processing of the transaction. All of that requires code, and you stand in line for IT, because everyone's showing up at IT saying, I need this, I need that, I need this. You put a ticket on the wall and then you wait, and I'm told end of June, so I just played it safe and said July 1st. That seems to be what you said around too. Yep, that's exactly what I said. Clarify your position on data providers recording how many companies are reporting in a given week. I don't know if I answered that. I don't know if I have a position on that. I don't know if I've ever brought that up. Do I say anything about that? Every week. It's because it's so shocking to me. It's just so shocking that you can't get this right, but you're telling me that you have all of this really important data that you're going to charge me big money for, but you can't get this right. Do you see what I'm getting at? Like, you can't get this right. The most objective thing you can do. See, I know what you did. You did it on purpose to get me going, eh? In slight defense of Keith Gill, not sure if you watched his previous videos or not, some of which are several hours long. Overall demeanor of him is similar to what was shown in the live stream. I've heard that it was pretty much on brand for who he is. Charts he uses, he's been using stock charts for years, if not since he started, so I don't find that it is odd. Yeah, I just found it odd that you were in E-Trade. It has charting capability that you would leave E-Trade and do something else, but if he's more familiar with another package, then that's fine. As is now common knowledge, he is a charter holder. I don't know if he still is or isn't. Specialized in deep value investing, hence the original position. From the surface view, it looked like he embarrassed himself, but at the same time, I think he was trying to make a point, possibly as a legal strategy, to show the real amount of influence he has had over the GameStop. Clearly not much. Yeah. I don't think that the SEC would have had anything on him, even if he had come out and gave an intelligent statement, or gave a statement saying, guys, I think you know what I'm about to say here. On the advice of counsel, I'm going to step away from this, but thanks for showing up. I mean, he could have just said that. Yeah. Do you only acquire stocks through puts? Not really. I buy. Do you sometimes outright buy? Yes, I do. I bought another 22,000 shares of CapREIT today. I never used options. I would like to start slowly. How do you recommend I get started? Buy small 10 delta puts on something you know and on something you don't mind owning. Any links, videos, books? Yes, the applied options. The applied options in the applied level will show you exactly how to do that. Maybe I'm just tired, but I don't see why, if the USD would take a hit, then everything US denominated would get a boost. Well, not really. If you think about the price of oil, let's say, or the price of gold at $2,300 an ounce, it's $2,300 US dollars. But if the US dollar dropped a lot, then if I'm holding gold as a Canadian, I would say, well, you got to give me more than $2,300 US dollars for this now. The US dollar is not as good and strong as it used to be. I'm going to want 2,400 of this just to get the same price in Canadian dollars. So anything denominated in US dollars would rise because the US dollar is weaker, but an ounce of gold is still an ounce of gold. So the ounce of gold will say, well, you're trying to buy me with weaker US dollars. I'm going to need more of them. Brother Mark, you're just mad. Kitty made 300 million and you didn't. No, not at all. But now that you put yourself out there, your is a possessive. Your hat, your car, your friend. I think what you meant is you're just mad. Mad, you wouldn't use the word mad. You'd use the word angry. Mad means something else. You're just angry. Kitty made 300 million. Well, you're wrong there again. He didn't make 300 million. He had the potential to make 300 million. By the end of the day, he did not make 300 million. And you didn't. I don't know if you've heard, but I'm quite wealthy. So no, it doesn't bother me that somebody makes money at all. I was impressed by the chess game up to that point. If you're going to be critical about somebody for no other reason than they're better than you, then they're just doing better than you, that comes from pettiness and spite. That you could make that comment suggests to me that you have a propensity for petty and spite. So Mr. Freddie Green, 1236. You should be careful about the statements you make. They seem to be more a reflection of your mindset than me, right? You can ask me if my comment was motivated by that feeling, but you cannot just tell me that that is what's going on. You don't know me. You don't know me. So careful. Your statement is more revealing about you than it is about me. And that is the end of it.